everyone. Welcome to the course on International Financial Management. In the previous lecture, we studied about the transaction exposure and its management. We know that transaction exposure is a risk that arises when exchange rate movements affect actual money flows that are already contracted. If an Indian company has agreed to pay dollars to a US supplier 3 months from now, and the rupee depreciates in the meantime, the actual rupee outflow increases. This is transaction exposure, real, tangible, and cash based. We can see its impact on the cash flows immediately. In this lecture, we move to another important dimensions of international financial risk, and that is translation exposure that extends beyond immediate cash impacts. Translation exposure arises when a firm consolidates its foreign operations into the parent company's financial statements. Another equally important dimension of foreign exchange risk, one that does not affect cash flows directly but affects something that every company cares deeply about, and that is its financial statements. Every company prepares financial statements to understand its financial health and position. It prepares an income statement to know its profit or loss, and a balance sheet to know what it owns and what it owes. Now, this preparation of financial statements is very simple for a company operating in one country. But things become a little more complex for a multinational company. This complexity leads to translation exposure, and it arises every time a multinational company sits down to prepare its consolidated financial accounts. Before understanding translation exposure, let us first understand two basic terms, that is, multinational company and subsidiary. A multinational company is a business that operates in more than one country. It expands beyond its home country by setting up offices, factories, or business operations in different parts of the world. Now, how does it operate in other countries? It does so through subsidiaries. A subsidiary is a company that is owned and controlled by parent company, usually through majority ownership, that is more than 50%. A large Indian MNC, say Tata, Infosys, or Mahindra, does not just operate in India. It has subsidiaries spread across the USA, Europe, Southeast Asia, and beyond. Each of these subsidiaries operate in its local environment. Hence, each subsidiary maintains its books and financial statements in the local currency of that country. The US subsidiary maintains its books in US dollar. The German subsidiary keeps its accounts in euro. The Singaporean subsidiary records everything in Singaporean dollar. And at the end of every financial year, the parent company must consolidate all subsidiaries into one set of financial statements expressed in the parent's reporting currency. When a multinational company operates across countries, it prepares financial statements in different currencies. It can be dollars, euro, pounds, yen. But ultimately, the parent company has to consolidate everything into one currency. In this example, the parent company is India, and the subsidiary companies are in countries like France, USA, UK, and Japan. Each of these subsidiary prepares its financial statements in its own local currency. France subsidiary prepares its financial statements in euro. USA subsidiary does it in dollar, while UK subsidiary prepares its financial statements in pounds, and Japan's subsidiary does it in yen. But the parent company in India cannot present financial statements in multiple currency. So it first needs to convert all these financial statements into Indian rupees. This means the financial statements of France, which are in euro, and the financial statements of USA that are in dollars have to be translated into Indian rupee. Translation exposure is also called accounting exposure. It is defined as the risk that a company's financial statement will be affected by changes in the exchange rates when translating foreign currency financial statements into the parent company's reporting currency. Let me emphasize two things about this definition. First, it arises from the need to consolidate. If a company had only one subsidiary in one country and never needed to prepare consolidated accounts, translation exposure would not exist in the way we discuss it. Second, translation exposure does not represent an actual cash flow. No money is physically gained or lost. If the rupee strengthens against the dollar and the US subsidiaries' assets translate to fewer rupees, no rupees have actually left the company. It is the book entry, a change in the reported number. But do not underestimate it because of that. A translation loss can reduce reported earnings, shrink the equity section of the balance sheet, worsen key financial ratios like debt to equity and return on assets, and affect how investors, analysts, lenders, and credit rating agencies perceive the company. In that sense, translation exposure has very real consequences, even if no cash changes hands. Now, here is where the problem comes in. When the conversion is done, the value in rupees depends on the exchange rate. And since exchange rates keep changing, even if the actual performance of the subsidiary has not changed, the reported numbers in the rupees will change. So, simply because of the conversion, asset may increase or decrease, profits may go up or down without any real change in business. Let's understand this with a very simple example. Suppose a US subsidiary has assets of $1,000 and a profit of $100. Now, when the parent company in India converts these numbers into rupees, the value will depend on the exchange rate. Let's say the exchange rate is rupees 80 per dollar. So assets becomes 80,000 and profit becomes 8,000. Now assume the exchange rate changes to rupees 85 per dollar. Without any change in the actual business, assets now become 85,000 and profits become 8,500. Now observe this carefully. The assets and profits have increased in rupee terms, but in reality, nothing has changed. The subsidiary in USA still has assets of $1,000 and profit of $100. Now think about this carefully. The exchange rate today is different from what it was a year ago. It is different from what it was when a German subsidiary first purchased its factory or when the US subsidiary first raised its long term debt. Which exchange rate do you use to convert each item? The current rate or the rate when the asset was acquired or an average for the year? These are not trivial questions. Different answers lead to different translated values. And the difference that arise from the conversion process are what we call translation gains or losses. Now, to understand translation exposure properly, we need to understand the four methods by which foreign currency financial statements can be translated. Because the choice of the method directly determines how much translation gain or loss appears in the account. Over the years, accountants and regulators across the world have developed different approaches to this problem. And at the heart of each approach is one fundamental question: for any given item on the balance sheet or income statement, should you use the exchange rate that exists today, that is the current or closing rate, or should you use the exchange rate that prevailed when the item was first recorded, that is the historical rate? The choice of the method, it is not just technical detail. It has very real implication for how companies' financial position is reported. Different methods determine which items are translated at current or closing exchange rate and which using the historical exchange rate. Because of this difference, the same set of financial statements can look quite different depending on the method used. And ultimately, this affects how much translation gain or loss is reported in the financial statement. So, understanding this method is crucial, not just for accounting purposes, but also for interpreting a firm's reported performance accuracy. Well, the four methods of translation are current non-current method, current rate method, monetary and non-monetary method, and temporal method. Let us go through each one in details. Now let us move to the first method of translation, the current non-current method. This method is very simple in its approach. It classifies all items in the financial statements based on their maturity, that is, whether they are short term or long term. First, let us understand what we mean by current and non-current. Current assets are those assets which are expected to be converted into cash within 1 year. For example, cash, inventory, receivables. On the other hand, non-current assets are long-term assets used by the business for more than 1 year, such as land, building and machinery. Similarly, on the liability side, current liabilities are obligations that have to be paid within 1 year, like creditors or short-term loans. And non-current liabilities are long-term obligations such as long-term loans or debentures. Now, based on this classification, the method applies different exchange rate. All current assets and current liabilities, that is, those with a maturity of 1 year or less, are translated at current rate or the closing exchange rate. Non-current assets and non-current liabilities, that is, having a maturity of more than 1 year, are translated at historical rate that applied when the item was originally recorded. And all income statements items like revenues and expenses are translated at average rate for the period. Common stock is always translated at the historical rate irrespective of the method. Retained earnings, however, are not translated directly. They are a balancing figure, influenced by the translation of income, dividends, and the treatment of exchange differences. This aspect remains consistent across all the four methods. Now, let us understand this simple example of current and non-current method. We have been given inventory. Now, inventory is a current asset. Fine. Since inventory is a current asset, it is going to be converted at the current rate. Let us say the closing rate, or we can also say it as the current rate, is equal to 85 rupees and the historical rate is equal to 80 rupees per dollar. Now we have to see where we are going to use the current rate and where we are going to use the historical rate. Since it is a current asset, The value is $500. So the inventory is going to be converted as per the current rate, which is going to be 42,500 rupees. Now machinery. Machinery is a long term asset and it is of 1000. So it is a non current asset. So which rate we will use? We will use this historical rate, and hence the rate, if we convert it, this is historical rate, and we convert 1000 into 80, the value of the machinery in rupee terms becomes 80,000. Now creditors. Creditors are what? Creditors are our current liability. So we know this current is very important here, current word. So we will use which rate? Current rate. Current rate. And it is 300 into 85. So this gives us 25,500 rupees. Now let's talk about the long term loans. Now this is not a current loan, it is a long term loan, and hence it is a non current liability. So hence how much it is? It is 700 and it is going to be converted into historical rate. So this is going to be into 80, and hence what do we have here? We have here 56,000. 56,000. Now let's talk about this profit. We have also been given that the average rate is 82 rupees and the profit is converted as per the average rate. So here we will use average rate, and this will be 100 into 82. So this is going to be 8200 rupees. So this is how we use current and non-current method. The key implication of this method is directly tied to the working capital position of the subsidiary. If the foreign subsidiary has current assets that exceeds its current liabilities, or in other words, if it has a positive working capital and if the local currency appreciates, the subsidiary will record a translation gain. Because those net current assets, when converted at the stronger closing rate, translate into more rupees than before. Conversely, if the local currency depreciates, the translation loss arises. The second method is the current rate method, also known as the all current method, and it is the simplest and most widely used internationally today. The logic is the most straightforward of all four methods. Almost everything is translated at the current closing rate. All assets and all liabilities, regardless of whether they are current or non-current, are translated at the closing exchange rate. Income statement items are translated at the average rate for the period. Only equity items, that is the share capital and the retained earnings, are translated at the historical rate. The key implication of the current rate method is its internal consistency, because every asset and every liability is translated at the same closing rate. The entire balance sheet moves together as one unit when exchange rate changes. There is no mismatch between different items using different rates. The third method is the monetary and non-monetary method. Monetary items are assets and liabilities whose value is fixed in terms of money and will be received or paid in the definite number of currency units. They are claims to fixed money. You already know exactly how many currency units you will receive or pay. The number is contractually fixed. For example, cash and bank balances, accounts receivables, accounts payables, loan taken or given. Non-monetary items are claims to value, not fixed money. So I repeat, it is a claim to value. Now claim to value mean you do not have a fixed number of currency units. What you hold is something whose worth must be measured, not received as a fixed money. Now, the value of that particular item depends on its physical form, whether it is machinery or inventory, usage or utility, market conditions. Example, you bought machinery for $10,000. You are not going to receive 10,000 back. You have a machine, not a money claim. Its value depends on its depreciation, productivity, resale price, etc. This method moves away from maturity based classification and instead focuses on the economic nature of each item. The question it asks is, will this item be settled by paying or receiving a fixed predetermined amount of currency? If yes, then it is a monetary item. Cash, accounts receivables, notes receivables, accounts payable, long term debt, all of these will ultimately be settled by paying or receiving a specific number of currency units. These are translated at the closing rate because their value in home currency terms changes directly with the exchange rate. If no, then it is a non monetary item. Fixed assets, goodwill, inventory at cost, prepaid expenses. These are not settled by paying a fixed amount of currency. Their value is tied to physical or economic reality, not to fixed monetary claims. These are translated at the historical rate. Now I will explain you monetary and non-monetary method in translation with the help of an example. We have been given an Indian company which has the following US dollar items on its balance sheet. We have cash which is 1000, we have debtors which is 2000, we have machinery which is $5,000 and we have purchased it earlier. We have inventory which is $3,000 and we have also purchased this earlier. The historical rate given to us, $1 is equal to 80 rupees and the closing rate is $1 is equal to 85 rupees. Now here if we see, this cash is a monetary item. Similarly, debtors is also a monetary item because we know that we are going to get the fixed, because we know that we will get fixed amount of cash currency in it. Since they are monetary item, they will be converted at the closing rate. And what is the closing rate? The closing rate here given to us is 85 rupees. So if I have to convert the cash, then it is going to be 85,000. And if I convert the debtors, that is $2,000, so it is 1,70,000. Now these machinery and the inventory that I have purchased earlier, these are non-monetary items. It is based on their physical condition and physical usage. So these non-monetary items are going to be converted at the historical rate. And the rate given to us is, which is rupees 80 here. So if I have to convert this machinery, it is going to be 80 into 5,000. This gives us 4 lakh rupees, and the inventory will be 80 into 3,000, which gives us 2,40,000 rupees. The key implication is that this method is more economically meaningful than the current non-current method. It asks, what the item actually is economically. Does it have a fixed monetary value that moves with the exchange rate, or does it have a real value independent of the currency movement? This distinction is more reflective of the economic reality. The fourth method is the temporal method, and it can be thought of as a refinement of monetary and non-monetary approach. The temporal method follows the same broad logic. Monetary items at current rate, non-monetary items at historical rate. But it introduces one important thing, and that is inventory. Under the monetary non-monetary method, inventory is always non-monetary and therefore always translated at the historical rate. But the temporal method says it depends on how the inventory is measured on the books, because accounting follows a key principle: anticipate losses but do not anticipate gains. Inventory can be valued at cost or net realizable value, whichever is less. Here, net realizable value is equal to expected selling price minus selling expenses. If the inventory is carried at the cost, then we use the historical rate. But if the inventory is carried at the market value or net realizable value, then we use the current rate. The underlying principle is elegant. The translation rate should follow the measurement basis of the asset. Whatever exchange rate corresponds to the point in time when the measurement was made, that is the rate to use. Cost price, then we use historical rate. Current market value, then we use current rate. This makes the temporal method more economically faithful than a pure monetary non-monetary classification. It ensures that the translated value is always consistent with how the asset is actually being valued on the books. Now here we can see the items, and we can see the various methods, the first, second, third and the fourth one. This is monetary non-monetary, this is temporal, current non-current, and this one is all current. Now here this is the current rate, C. C means the current rate and H means the historical rate. Now you see the capital stock here and the retained earnings. Now for every this they are valued at the historical rate, while if you see the current assets, they are always in the valued at the current rate, and the inventory only in monetary and non-monetary method it is valued at historical rate, while in temporal it can be valued at the historical rate also and the current rate also. Let's again understand it in a better way. So now looking at how these four methods, let us compare across specific balance sheet items, because this is where the practical differences between the methods become very clear. Now if we look at the comparison table, a few observations comes out. Cash and accounts receivable follow the current rate under all methods. They are monetary items by any classification, and their home currency value changes directly with the exchange rates. So, fixed assets use the historical rate under 3 of the 4 methods. Only in the all current method, they translates them into the closing rate. This is because fixed assets are non-monetary, non-current and carried at cost. 3 characteristics that point to historical rate under current, non-current, monetary, non-monetary and temporal methods are alike. Inventory is the most interesting item. Under the monetary and non-monetary method, it always uses historical rate, while under the temporal method, it depends on the measurement basis, whether it is measured at cost. Then if it is measured at cost, it means historical rate will be applied, and if it is valued at market price, then the current rate will be applied. Under the non-current and current method and all the current method, it always uses the current rate. Long-term debt is another notable differences. Under the non-current and current method, long-term debt uses the historical rate because it is non-current. But under the monetary and non-monetary method as well, in the temporal method, it uses the current rate because it is a monetary item. This is one of the most significant practical differences between the methods. And if we see equity, that is both capital stock and retained earnings, they use historical rate across all four methods. Capital stock is translated at the historical rate because it represents the original investment made at a specific point in time. Retained earnings, as I mentioned earlier, is technically a derived or plugged figure. It emerges from accumulated translated profits rather than being independently translated at a specific rate. And that brings us to the end of today's lecture. We began by linking translation exposure with transaction exposure, noting that while transaction exposure affects cash flows, translation exposure impacts financial statements and reported performance. We then looked at the four translation method and how they determine the exchange rates applied to different items. In the next lecture, we will understand the distinction between integral and non-integral foreign operations, and we will also examine how to translate income statement and how firms manage this risk exposure. Thank you. I will see you in the next class.